Hello everyone and welcome back. In today's video, we'll break down IAS 12 income taxes and understand how current tax and deferred tax really work. So IAS 12 is the standard that prescribes the accounting treatment for income taxes. Income tax is the aggregate amount included in determination of profit or loss for the period, and it includes current tax and deferred tax. And the prime focus of IAS 12 is the difference that it accounts for the difference between accounting profit and taxable profit. The objective of IAS 12 is to ensure that tax effects of transactions are recognized in the same period as the transactions themselves. This improves matching and gives users a more accurate picture of current tax obligations and future tax effects, and the real impact of tax on profits. Now let's just understand the scope of IAS 12. So IAS 12 applies to all the income taxes, whether they are domestic taxes or foreign taxes. And it also applies to withholding taxes on dividends. This means that the taxes deducted at source when dividends are paid are also treated as income taxes under IAS 12. What is excluded under the scope of IAS 12? First, IAS 12 does not cover accounting for government grants. For this, IAS 20 is applicable, and IAS 12 also excludes investment tax credits, but any temporary differences arising from them are still covered by IAS 12. To understand IAS 12 properly, we need to be clear about some key terms as mentioned here. These include accounting profit, taxable profit, temporary differences in tax base. Most of IAS 12 calculations and explanations depend on these definitions. So to simplify IAS 12, I have taken a certain framework. This framework shows that income tax is further divided into current tax and deferred tax. Current tax is the tax payable or recoverable for the current reporting period, whereas deferred tax relates to future tax consequences that arise because accounting rules and tax rules do not always treat transactions in the same way, leading to taxable profit not coming equal to accounting profit. When this situation arises, then we have some temporary differences or permanent differences. What are permanent differences? So, in case of let's say fines and penalties, in case of some breach of law, accounting records such fines penalties as an expense, but tax laws forbid to do so. So this will be a permanent difference. Like in any case, this will not be reversible. So IAS 12 ignores such expenses. The primary focus shifts to temporary difference, which leads to deferred tax assets and deferred tax liabilities. This slide also shows how tax expense is structured. So you see tax expense can be either current tax plus deferred tax liability or current tax minus deferred tax asset. This framework shows that tax expense includes both current period tax and future tax effects. The difference between accounting and taxable profit arises due to difference in depreciation rules in accounting and tax laws. Some non-deductible expenses which are allowed by accounting and disallowed by tax or vice versa, and timing of income recognition difference between accounting laws and tax laws. So to explain temporary differences, these arise because income and expenses are recognized at different timings for accounting and tax. So you see these temporary differences are also sometimes called timing differences. These are of two types: taxable temporary difference, also called deferred tax liability, and deductible temporary difference also known as deferred tax asset. So let's quickly understand them with the help of an example. Here, this is this these amounts are calculated in accordance with accounting laws, and these amounts are calculated in accordance with tax laws. So you see, Revenue is 4,000, warranty expense is 80, taxable income is 3920, tax payable is calculated on 3920, which is also called the carrying value. So you see here is the tax according to accounting laws, and according to accounting laws it has included warranty expense, which means that in case when a customer claims warranty in future, so expense is already recorded, but tax forbids such kind of recording. So you see here in tax, according to tax laws, the warranty expense is zero. It waits till the cash is paid by the company. So you see here the tax base is higher than the account carrying value. So you see, as the slide suggests, when the carrying amount is less than tax base, when the carrying amount is less than tax base, it gives rise to deferred tax asset. The difference is taken of the two and tax rate is applied, which gives us the value of deferred tax asset. So the thing to be understood here is that you see that according to tax expense is higher, and according to accounting books tax expense is lower. We will take this into account. So you see, more tax is paid in the future, which will lead to tax saving in more tax is paid today, which will lead to tax saving in future. This is the concept behind deferred tax asset. And same but opposite for deferred tax liability. You see, in accounting books, the cost of asset is 100. For deferred tax liability, depreciation is the best example. Accounting uses straight line, which gives carrying value of 800. But tax, according to tax law, it uses accelerated method, so which gives taxable income or tax base of 600. So you see, the difference of the two is taken and tax rate is applied, which gives to amount of deferred tax liability. But again, the thing to be understood here is that you see the tax expense is lower today than what is shown in the accounting books. So you see, this is the expense which is going to be subtracted. So less tax is paid today, which means there will be higher obligation in the future. So this gives rise to deferred tax liability. This is the main concept behind temporary difference. I hope you got it. Now, for the recognition, so how can we, just summarize this core principle for IAS 12? Recognition under IAS 12 ensures that both current tax and future tax consequences are captured. So IAS 12 requires recognition of tax for the current period taxable profit, which includes current tax plus deferred tax. Taxable temporary difference leads to future tax payments, deferred tax liability, and deductible temporary difference lead to future tax reductions, deferred tax asset. Only future profits are likely. I have told you about these two before. So for measurement, for current tax, we simply, for current tax, we simply use the tax rate and tax rules that apply to current year's taxable profit. But for deferred tax, the IAS 12 looks to the future. Deferred tax is measured using the tax rate that is expected to apply when the difference reverses in the future, not the rate used today. And another important point is that deferred tax amounts are not discounted even if they will reverse after many years. How are the taxes presented in financial statements? So IAS 12 separates current tax from deferred tax in the balance sheet. How current tax balances are presented as current assets or liabilities, whereas deferred tax balances are always presented as non-current assets or liabilities. In the statement, on the contrary, in the statement of profit or loss, tax expenses include both current tax and deferred tax. Lastly, for disclosure, so IAS 12 requires companies to explain why the tax expense shown in the financial statements is not simply accounting profit multiplied by tax rate. Entities must disclose the split between current and deferred tax. A reconciliation explains differences between statutory and effective tax rates. Deferred tax assets not recognized must be explicitly disclosed. And these disclosures help users understand the company's future tax position. So before moving to the final slides, let's just take an example. So here, Pearlco bought a machine on 1st January for $1 million. It will be used for 10 years and the company expects to sell it at the end for 100,000. This is the scrap value of asset. The company charges straight line depreciation for accounting and the carrying values are as follows. Whereas for tax purposes, depreciation is allowed at 20%, accelerated. And these are the corresponding tax-based values, or you can say carrying values according to tax. Income rate applied is 20%. Calculate the following for the year ending 31 December 20x2. The deferred tax charge or credit in the statement of profit loss, the deferred tax balance in the statement of financial position. So I will guide you how to solve this question and we will follow these steps. So first look at step 1. First step is always to calculate the temporary difference. So you see for first year the carrying value is 910 and tax base is 800,000. So the difference of these is 110,000. And for second year carrying value means according to accounting books is 820 and tax base is 640, which will give us temporary difference of 180,000. Now you have to determine if this is a DTA or DTL. You see, in both cases, the carrying value is greater than tax base. The carrying value is greater than tax base. If you have forgotten, let's go back to the slide. So when the carrying value is greater than the tax base, this is a deferred tax liability. So we have determined this is a deferred tax liability. Okay. Now we will calculate the closing deferred tax liability. How we will do that? We will simply multiply the temporary differences with the tax rate. Tax rate is 20%. So you see for the first year, 110 is multiplied by 20 gives 22,000, and for the second year 180 multiplied by 20 36,000. Step 4, calculate the deferred tax charge. Deferred tax charge is equal to closing DTL minus opening deferred tax liability. So we have not given the opening DTL, so we will assume it's 0, and closing DTL is for first year is 22,000. So closing minus opening 22. For second year, closing is the opening. So 22,000 and closing is 36. So 36 minus 22, 14,000. So you see, now this 22,000 will be charged to profit and loss in the first year, and for the next year, since you see that 22,000 has already been charged, so we will do the difference and charge 14,000 in the next year. Okay, so you see that for profit and loss for the first year, current tax plus deferred tax amount of 22,000 will be charged as shown here. And for the second year, current tax plus 14,000 amount will be charged. And for balance sheet, you see there is no current tax given. So we'll, as I have discussed before, the current tax will be considered a current liability, and the deferred tax amount will be considered a non-current liability because it is usually set off in a period of 2 to 3 years. And for the second year, you see that again the current tax is current liability, but for the second year in the balance sheet, always remember that always the closing amount goes to the balance sheet as a non-current liability. Okay, so you see here we have added the closing amount. Going back, hope you understood the example. Now going back to the slides, what are the mistakes to avoid? Okay, so the first mistake is misclassifying temporary differences and permanent differences. You have to keep a difference between the two. The second mistake, deferred tax assets can only be recognized if future taxable profits are available. So if this condition is ignored, deferred tax assets may be overstated. The third mistake, deferred tax liabilities are generally required under IAS 12, and skipping them leads to understated tax obligations. Fourth mistake, IAS 12 requires deferred tax to be measured using the tax rate expected to apply when the difference reverses. So don't take today's rate for deferred tax. And lastly, providing incomplete disclosures. This reduces transparency and makes it harder for users to understand the tax position. Lastly, the key takeaways. First, IAS 12 accounts for both current tax and deferred tax. This means tax reporting looks at both today's tax and also future tax effects. Second, temporary differences between the carrying amount of asset or liabilities and their tax base are what drive deferred tax accounting. These timing differences explain why deferred tax arises. And finally, deferred tax liabilities are generally mandatory, meaning they must be recognized when taxable temporary differences exist. In contrast, deferred tax assets are only recognized when recovery is probable, so there must be enough future taxable profits. These 3 points capture the core logic of IAS 12. This brings us to the end of this video. Thank you for watching it. See you in the next one. Till then, take care. Bye bye.